index fund is one of the simplest ways to invest, even though it sounds complicated at first. Instead of trying to pick one company and hoping it becomes a winner, an index fund lets you own small pieces of many companies at the same time. Think of it like a basket. Inside that basket are hundreds of different companies from all parts of the economy. When you buy an index fund, you're not betting on one business, you're betting on the overall market. For example, an S&P 500 index fund owns the 500 largest companies in the United States. That means when companies like Apple, Microsoft, and Amazon grow, the fund grows too. And if some companies struggle or fail, others can still succeed, helping balance things out. This is called diversification, and it reduces risk without you having to do anything extra. Instead of trying to outsmart the market or constantly buy and sell stocks, index funds simply follow the market over time. When the economy grows, index funds tend to grow with it. When the market goes down, they may drop too, but historically they recover as the economy recovers. That's why index funds are usually used for long-term investing, not quick trades. The reason many investors prefer index funds is because they're simple, low stress, and consistent. You don't need to watch the market every day or react to every piece of news. You just invest, stay patient, and let time do the work. Index funds may not be exciting, but they're effective. And that's why so many long-term investors rely on them to build wealth over time.